National data continues to provide insights into buyer sentiment and market direction. I'll cover full updates on inventory and what Fannie Mae is reporting about market conditions. The Federal Reserve recently met and new inflation reports are out. While inflation is starting to get under control, it's not enough yet. Stick around to hear what the Fed's plan to do for the coming months. San Diego's market is consistent with national trends. What does this mean for buyers and sellers in the coming months? I'll break it all down for you here. All this covered here in this week's San Diego Market Matters. I'm Karl, your San Diego Realtor. Let's jump into it. Real quick, if you appreciate the information I provide in these videos every week, do me a favor and like the video or subscribe. It helps tremendously for my channel. And if you're thinking of selling or buying here in San Diego, check out the link in the description below where you can schedule a meeting with me so we can discuss your goals and how I can help you achieve them. Or if it's easier, you can call me directly. Whatever works best for you. Now, on to the good stuff. Housing inventory continues to rise nationally, hitting levels not seen since the second half of 2020. San Diego's inventory is also growing, closing May out with over 4,000 homes on the market, the highest we've seen since late 2022. Though we are on the rise nationally, new listing data is still struggling to catch up to 2022 levels. And this goes for San Diego as well. With 2023 being a rough year for inventory for everyone, the increase in inventory this year has been a breath of fresh air, not only for buyers, but also for us agents. We finally have homes to show our clients. We'll have to sit tight and see what new listing inventory will do over the next few months. As of right now, it doesn't look like we'll reach peak 2022 levels nationally or locally for new listings. Hopefully, we'll at least finish off the year with more new listings coming to market than we did last year. All this data goes hand in hand with recent mortgage application trends. Mortgage purchase applications have been down compared to previous years, which is helping current buyers by reducing competition and slowing price growth. This could be the great opportunity for you to get into the market now. As a matter of fact, with elevated rates, increasing inventory, lowering demand, the Redfin CEO predicts price declines this summer as more sellers, those waiting for lower rates, enter the market. However, I think we'll see stabilization before any significant price drops. Here in San Diego, prices are holding steady and market time is still under 30 days. This does seem a little preemptive being that this article was written in this month and technically summer starts next month. I don't agree that we're gonna see enough inventory come to market in the next 1 to 3 months that would offset demand that much. Plus, we should first see a flatlining of the market before we start to see it going down. Here in San Diego, we still are showing strength in our numbers. Sales are still up, prices are either holding or continuing to inch their way up, though way more slowly than before. On top of all of that, our market time is still sub 30 days. I believe at the earliest, market time would need to get to 60 days before we start seeing prices come down, but more reasonably, it should be 75. To recap, San Diego is in alignment with what is happening nationally for the most part. With more inventory and less new buyers coming to market, this equals more opportunity for current buyers wanting to get into the market. As for sellers, pricing strategy should be a point of focus when speaking with your realtor, i.e. me. The last thing you want to be is the person who helps to sell everyone else's home over yours, and then before you know it, the market shifts on you. Fed Chair Jerome Powell put his foot down and holds interest rates where they are yet again. And in addition, he suggests maybe, possibly, hopefully, we'll see one cut by the end of the year. Now that's a long way away from the 6 rate cuts they suggest in December in 2023 and the 3 cuts they promised earlier this year. Is it only me that thinks all this talk of these rate cuts is absolute garbage? At this point, it's only being used to spur excitement and give the consumer hope of a promising future. And let's be honest, spending is strong, labor is barely softening, and the stock market is showing some of its highest highs ever. Do we really need a cut anytime soon? Bottom line, the elevated Fed funds rate is starting to show its impact on the economy, which is what Jerome Powell suggested at the FOMC meeting over 45 days ago. At the press conference following that meeting, he said that the economy only needs more time to show the impact of the Fed funds rate at that time. Fast forward to today, the PCE, personal consumer expenditures, essentially the canary in the coal mine regarding inflation, showed inflation down to 2.8 year over year. CPI, the consumer price index, the metric the general market follows that has a major influence over the stock market during every announcement, That was down to 3.3% and shows no growth in the month of May. Then we have core CPI, which is like CPI but without food and energy due to their volatility. That's down from 3.6 1 month ago to 3.4, thus leading the charge of the S&P reaching a record high in the stock market. Lastly, we have PPI, Producer Price Index, the precursor to CPI, the metric that measures the cost of raw goods and production. If these costs go up, the manufacturer passes those costs on to the consumer, thus influencing CPI. PPI comes in below expectations, down 0.02% in May, previously having been up 0.05% in April. Okay, I threw a few abbreviations at you really quickly. Bottom line, they're all coming down. If you're wondering why there are different metrics to measure inflation, it's because there's so many influencers of it as well as different stages. Economists break up the different aspects of inflation to make more accurate measurements and also to determine where the higher levels of pressure are over others. For example, PPI was high during COVID because the cost to access raw materials to create goods was screwed up due to the whole supply chain issue. This caused CPI to go up. As soon as the supply chain got back under order, we eventually started to see the pressure being relieved in PPI, and the CPI followed afterwards. So really good reads coming back, but in the eyes of the Feds, these signs are not strong enough, and they suggest it's still too early to tell. Jerome Powell advocates that we need more data to determine if the Fed's fund rate is 1, high enough to get us down to 2% inflation, and 2, if inflation is actually on a downward trend. Remember, the goal of the Fed is to get inflation down to 2% while maximizing the labor market. The Fed current predictions are that we won't reach a 2% inflation rate until sometime in 2026. 2.8 this year, 2.3% in 2025, and finally 2.0 the year after. Doesn't this lend to exactly what I was saying earlier? If the Fed's goal is to get inflation down to 2% while keeping the labor market intact, then the only reason the Fed would need to cut rates between now and their prediction of the 2% inflation being reached in 2026 would be if the labor market totally went to shit. On top of all of that, I think Jerome Powell holding ground is a strong sign that the future for the Fed funds rate is not only limited to being cut. If inflation retains its stickiness that it's showing in that 3% range, the Feds may have to raise rates some to get inflation down to 2%. Further, Jerome Powell responds to the state of the housing market as complicated. He states that we had a shortage of housing before the pandemic, we had a shortage of housing during the pandemic, and still a shortage afterwards. Rates, though they'll be helpful to curb the excessive growth in price we've experienced over the last few years, raising them will not be enough to solve the primary driver to pricing going up, and that's a lack of housing. Simple as that. Now for San Diego numbers. What everyone wants to know is, when is a crash going to happen? Well, it's not. So we can end the discussion on that there. There has been too much stability in the buyer's market over the last decade, and the jobs market is too strong for us to see an overwhelming number of homeowners suddenly become financially disqualified from owning their current homes, especially the large portion of the market of homeowners that have a 5% interest rate or lower. Now, if you're wondering when is the next market correction, as I mentioned in my last Market Matters video, it's very unlikely that it'll happen this year. San Diego barely got above 4,000 homes of inventory at the end of May, while pre-pandemic inventory levels were well above 12,000 homes. Now, pre-pandemic interest rates were 4 to 5%, so it is reasonable to say that we don't need to get over 10,000 homes before we hit a correction in the market. Here's what you want to watch. The key metric is market time. If you look over the last 20 years in San Diego, the point at which prices were the lowest was in 2012, and guess what the market time was back then? Over 100 days. Now, that was in combination with an overwhelming number of short sales being processed through bank loss mitigation departments. Those naturally took way longer to locate an offer, then get approval from the bank to take the loss, and then to sell to the next buyer. Our current market time is reasonably under 30 days, 24 if you want to be exact. When San Diego gets to 75 days on the market, if if I were you, I'd start checking out the number of price reductions taking place at that time. If you're seeing 60% of homes or more doing a price reduction, then that's a good sign that we're on the precipice of a correction here in San Diego. Keep in mind that this is an estimate based on patterns, and this is exactly why watching these Market Matters updates will keep you ahead of the game here in San Diego. As various factors adjust, you will be updated here so we can plan your next move accordingly. Now, thanks for tuning in to this week's San Diego Market Matters. If you found this information valuable, hit the like button, subscribe for the weekly updates, and share your thoughts in the comments below. As always, I'm Karl, your San Diego Realtor. I'll see you next video.